When conventional banking wants to fund a business, it issues an interest-bearing loan. It demands a guaranteed return, regardless of whether the entrepreneur succeeds or fails. But ethical finance rejects this asymmetry. Today, we break down Mudaraba, a sophisticated commercial partnership built entirely on shared risk, human labor, and mutual trust. A Mudaraba contract functions through two distinct entities. First is the Rab-al-Maal, the investor who provides 100% of financial capital. Second is the Mudarib, the manager or entrepreneur who contributes zero financial capital, but provides 100% of the labor, execution strategy, and technical expertise. Unlike conventional financing, where a bank charges a fixed interest rate on the principal, a Mudaraba partnership utilizes a pre-agreed profit-sharing ratio. If the business makes money, those returns are split by percentage, such as 60-40 or 70-30. This ensures that the investor's reward is directly tied to the actual real-world success of the business. But what happens if the business completely collapses? This is where Mudaraba reveals its radical ethical foundation. If a venture suffers a legitimate financial loss, 100% of that monetary deficit is absorbed exclusively by the investor, the Rab-al-Maal. The entrepreneur cannot be forced to pay back the lost capital. At first glance, conventional economists argue this is unfair to the investor. But Sharia jurisprudence notes that the entrepreneur does suffer an equal loss. While the investor loses their money, the entrepreneur loses their human capital. Their months are years of uncompensated sweat, equity, time, expertise, and reputation. Both parties take a heavy risk. There is, however, a critical legal guardrail. The entrepreneur is treated as a trustworthy trustee. If the loss occurs due to natural market conditions, the investor pays. But if the entrepreneur violates the explicit terms of the contract, commits fraud, or acts with gross negligence, the shield drops. They become personally liable to repay every single dollar of the investor's principal. How does this ancient concept scale to global asset management today? Look at Islamic retail banking. They deploy a structure known as a two-tier Mudaraba to completely eliminate traditional interest-bearing savings accounts. In Tier 1, you, the depositor, act as the capital provider, and the bank acts as the manager to invest your funds cleanly. In Tier 2, the bank takes those pooled deposits and acts as the capital provider to fund real-world corporate expansions, technology infrastructure, and housing projects. The profit flows back up the pipeline, entirely replacing the need for riba. For tech professionals, the parallels between Mudaraba and Silicon Valley venture capital are unmistakable. Both systems prioritize equity investment over predatory debt, back early-stage human talent, and realize that true economic expansion requires taking an honest, calculated risk together on the future. The Mudaraba framework proves that finance doesn't have to be extractive. It provides an institutional blueprint showing that capital and human labor can step onto the economic playing field as equal respected partners. While Mudaraba features a silent investor and an active manager, our next model takes partnership a step further. In our next lesson, we break down Musharaka, the fully integrated joint venture structure, where all parties contribute both capital and labor to build long-term infrastructure. Hit subscribe, and let's keep building wealth with a conscience.